Good afternoon, everyone. You're all very welcome to our weekend markets roundup, I suppose, for what's been another very volatile week in the financial markets. Of course, we're going to be looking at a wide variety of assets. So we're going to obviously look at the movements in the stock markets and the relevant movements in some of the FX markets. And of course, we will take a look at some of the other markets as well, like gold and oil. So I suppose very quickly, I suppose the big talking points last week was that really kind of counterbalance, because of course the last couple of weeks we've had the Fed, we had that little bit of a sell-off. Then of course into the end of last week, beginning of this week, we had the markets actually recover, and we've seen by and large through the course of the week the markets actually continue to finish really strongly for the week, despite that little bit of a blip in the middle of the week. So I suppose from that perspective, we are seeing a fairly strong, robust recovery in the markets, broadly speaking, against maybe some of the expectations of negativity, of recession, and of course of weaker growth, which is, I suppose, some of the main kind of themes that have been taking place or have been discussed in the markets, let's say, over the last few weeks. So of course, it is important to note that, yes, if the global economy is in recession, it doesn't necessarily mean that the stock markets will continue to decline, because on average, it is actually quite noticeable that stock markets decline generally occur approximately 6 to 9 months before a recession is actually official, okay, until it actually officially becomes public knowledge, until it's discussed in the media, etc. It is obviously an element to take into consideration. So of course, we've seen the stock markets continue to fall all year. We've had 11 months of continual declines. Every kind of short-term rally in the markets has been sold with equal, if not greater, ferociousness. And of course, then you have to look at the elements associated with the midterm elections. So normally speaking, in every 4-year cycle, the stock market bottom actually tends to occur in the approximate region of the midterm election. So that's not necessarily meaning that for the next 12 or 18 months, the stock markets are going to continue to rally and they're going to remain above some of those lows we've seen over the last, let's say, 6 to 8 weeks or so. But it is, looking back at history, it has taken place quite a number of times. So it's, of course, from a trading perspective, from a short-term, medium-term, and longer-term perspective, it's important to have clear rationality when you're taking positions, when you're executing trades, albeit regardless of the length or duration of those trades, that you have a clear focal point as to what you're looking for. So making sure you have significant confidences for buying or selling the asset you're buying, but also making sure that you're sticking to your risk, you're sticking to your defined metrics to keep you in line, to make sure your psychology stays in tune, because obviously psychology is very important when it comes to trading and investing, and making sure you stay on, I suppose, the clear path. So that's obviously kind of very interesting. Now, of course, when you look at the calendar this week, I suppose we're going to talk about it obviously because we're going to have a number of videos this week, but we have a lot of data coming out this week, and we'll be going through it daily, taking everyone through kind of the major events, and of course recapping then, as I said, on last week's movement. So of course, without further ado, let's get to the charts. Okay, so first and foremost, really, I suppose the big talking point, which has enabled the stock markets to show the recovery it's done so in recent days and weeks, has very much been brought about by the sell-off or the decline in the dollar retrospective to what's happened in the last, let's say, 3-6 months or so. So you've seen from the summertime, you've seen from even the beginning of autumn, August into September, the dollar has continued to rally up until effectively the beginning of November, where we have seen that collective pullback in the dollar back into this 106 level. Now, structurally speaking, as the dollar continues to decline, we know the correlation within markets suggests that you will get prosperity, you will get growth in the equity markets, because we know the dollar, the equity markets are generally negatively correlated. Okay, so we know when the dollar has been weaker, we have seen over multiple weeks of price action now, the S&P, the Nasdaq, the Dow Jones have all been outperforming because of the shift in market sentiment, the shift in investor sentiment from risk orientation or risk safety assets, so like the likes of your dollar or your treasuries, your safer havens, into more aggressive asset classes. Okay, and that's of course been reinforced by this dollar weakness over, let's say, the last 2 weeks or so, from today, which is the 20th of November, right back to the early parts of November, kind of the 3rd or 4th, where we've seen that very, very clear sell-off, where we've gone from 113, 113.50, all the way back down to this 106 hand. Now, of course, all good things must come to an end. Now, as we look at the price action, we have seen very, very clear selling in the dollar, all the way back to this daily liquidity level, as we said here, around 106. So 106 was always going to be the key narrative last week into the close, to see how does the markets close, but also to see what kind of position do we clear or do we end the week on. Now, of course, if you had to say that the dollar continued to sell off into the close, that would have been extremely positive for the indices. You would have probably seen another weekly high last week into the close on Friday, and you would have seen that positivity continue. Now, when you look at the dollar, let's say over the last week or so, you can see how the dollar has become very concentrated, as I said, between this 106 and 107 level. Okay, we've seen, yes, of course, we did have a failed break of structure on Thursday. We did get that pullback on Thursday to this daily level again at 106.35. But into the weekly close, even though the indices done quite well last week and closed fairly high, we are starting to see a bit of a reflection point here in the dollar. And that really becomes cause of concern, because if you are long indices or you are long risk assets, you then need to see, well, is this shift in dollar weakness going to continue? Because if it doesn't, and we see the dollar break this kind of bearish price action structure that we've seen over the last, let's say, 2.5 weeks or so, then the likelihood is you're going to get orientation out of those riskier assets back into the safer havens, like your dollar, like your treasuries, etc. And you're going to see euro dollar sell off. You're going to see pressure in cable. You're going to see upside pressure in dollar CAD. You're going to see pressure in gold. And also as well, bifocal to that is you're going to see pressure in the stock markets as well. Okay, you need to be looking at what's your risk on currencies. Well, you know your risk on currencies are your Aussie, your Kiwi, your CAD. You know you're obviously they're positively correlated or generally positively correlated with stock market returns. So then you know if you're trading, let's say, FX markets and the dollar starts to strengthen, well then really you're looking at hedging out of Aussie, Kiwi, CAD, Euro, because of obviously the negative correlation with the euro and the dollar, and back into these safer assets, just to give yourself a clear focal point. And it's when you know which way the sentiment is going, it gives yourself a very, very clear dynamic of what to look for, what assets to trade, and what way the directional bias is tilting towards. Okay, and that's whether it's risk orientation into safer assets or out of safer assets into riskier assets like your stock markets, like your Euro, Aussie, Kiwi, CAD, gold, etc. All right, and that really becomes the focal point this week, because as we know, 107 is, I suppose, the breaking point. If we can get a closure above this level here, that's really breaking the structure of this selling trend that we've seen over the last few weeks. We're seeing the price action then break structure. So of course, then we're seeing then the emergence or the creation of this counter trend pullback against this selling bias, and also the potential to see, well, if you go back to the daily time frame, every time we've sold off in the dollar, we've just made a new high. So then that becomes in the focal point. Well, if this is the bullish trend, okay, where we've made new highs consecutively all year, new pullbacks all year, and this becomes the new pullback level, rather than seeing the price action go to potentially back up into this region around 110, 111 on the DXY, could we potentially see a greater evolution of price action in dollar strength, see potentially that shift in sentiment in the stock markets in these riskier assets, and then see, are we going to potentially kick on again and go to new highs? Now, whether we go to new highs in the DXY, that is obviously a very, very open conversation that market participants are currently having, because of course, if we see the dollar go to 116 or 120, that will generally mean you will see further declines in the stock market. You will see hedging or out of risky assets into safer havens. Okay, so it's just important to understand the sentiment behind the logic and the thought process as well, because otherwise you don't want to be maybe buying or selling an opportunity and then maybe get your sentiment or directional bias wrong. I suppose that's really important. So looking at the bias now, of course, if you're looking at stronger dollar, you really need to see this kind of 1 hour structure level here around 107.20 to be broken, because that's of course allowing for a breakout in dollar strength. And then of course you're looking for the smart money, you're looking for the liquidity traps, you're looking for the fair value moves, and then of course then you're looking to see then can we get that elongated pullback then if that initial observation gets confirmed. And that's really kind of the most important element. If I could stress anything this weekend, that would be really, really important to look at. Now, similarly, again, with the yields, with the treasuries, we have seen that very, very clear top formation from 4.2 back to 3.7. You can actually see again, right, price action did sell off viciously from that 4.2. So that's a 0.5% sell off in the treasury yield, which is quite a lot, particularly in a less than a 2 week period, week and a half period. But however, we're still keeping this bullish trend from August, and more poignantly, the more aggressive, longer term trend in higher yields intact. And of course, the weekly close last week suggests that maybe this area around 3.7, 3.8% could be a short-term bottom, because when you look at it, particularly on the weekly, you can see that the price action is trading at its highest point into the close since March of 2010. So that was obviously leading back to the earlier onsets of recovery from the great financial crisis of 2008. So that's obviously kind of where we are. Now, when you look at the Treasury yields shorter term, you can actually see that there's been quite a nice bounce from those lows at 3.7. So, of course, you can see the bearish short-term bearish order flow. We are trying to take this out. So if we see all this bearish order flow up at 3.9 being taken out and price action navigates back above this kind of 3.9%, 3.95, then you could very easily see this drift higher again back into this region up here. And that again, of course, allows or enables that shift in sentiment from, I suppose, aggressive asset classes or riskier asset classes back into the safe haven rotation again. Now, moving across to the euro dollar. The euro dollar and some of the FX pairs have been quite choppy the last couple of days because, of course, if you look at euro dollar, firstly, from just on a kind of initial observation, price action had taken out those initial lows we talked about in September. So that initial low at 102 was very, very clearly taken out the tail end of the week before last. And of course, the price action has continued all the way up, taking out this liquidity area here from August and has pulled back into this move up here between 104 and 105. Now, you can also see initial observation on the daily time frame that this area here, the last buying candle before that real kind of ferocious selling breakout, right? This has now been mitigated because the price action came back up here to this daily level last week, which was fairly clear. Of course, it really only became clear kind of Thursday back into Friday till the middle of the week when we got that kind of clear rejection. And the markets is now sitting very, very evenly poised here around 103. Now, of course, if we see a break of structure through 103, that's allowing the DXY to continue strength. If that DXY continues strength, then you're really looking for break of structure, break of this low. You're looking for that kind of pullback, and then you're seeing, are we going to get that shift or continuation in trend? Dollar, stronger dollar, weaker euro, and then of course seeing that symmetrical shift in sentiment in the markets, allowing people to say, well, we're getting out of riskier assets, we're getting into the safer havens, and of course then we're seeing a shift in market bias, and that really becomes the big talking point this week. Okay, above all else. Now, when you're looking at the 4-hour structure, you can kind of see it here very, very clearly. This area around 103 has been very, very clear. Now, of course, if you look at a 4-hour, 1-hour time frame, you can kind of see how the markets have reacted because you've got that kind of consolidation area here. Very, very clear reaction. Okay, so that's really kind of the talking point here. This 103 to back to kind of 102.80 is really dependent on how does the price action react around this region, right? We've consolidated, we're consolidating. If the price action breaks through, it's taking out all of this consolidation. It's already rejected the daily zone and it's initiating a potential change in sentiment. And really that's what you're looking for. So if you're looking at maybe getting short in any of the stock market indices, you're really looking for that shift in sentiment first. You're getting that initial observation, that initial impulse. Then you're looking to see if there's any sort of mitigation of price action of the initial impulse. And then you're looking to see, can you piggyback on the existing trend in line with institutional order flow in terms of institutional and banking order flow. All right. So that's kind of really where we are there in euro dollar. If we move to cable, again, a very, very similar scenario. So cable has been on a very, very strong recovery, as we talked about last week. We've had that very, very clear bullish order flow all the way back into this 120 level that we talked about. And we did mention 120 level back here even the last week and a half or so when we're kind of sitting back at 115, 116. And don't be surprised to see it happen, particularly off the backdrop of that weaker dollar. And we have seen the DXY continue to weaken, obviously, over the last week or so, which has allowed the cable to flourish back into this 120 handle. Now, of course, cable was quite choppy last week because, of course, we did have some internal commentary, updates, policy statements from both Bank of England members, but also from Jeremy Hunt, who's obviously Treasury within the UK government as well. So obviously looking at his inputs, his commentary, particularly from a budget perspective, but also from a fiscal policy perspective, because markets are driven off of obviously the liquidity, but they're also driven off of arbitrage, which is short-term movements on price, short-term movements in the markets, which hasn't been priced in. So that's where you get your algos, that's where you get your manipulation at a very, very quick rate because of this arbitrage. It's important to be aware of the arbitrage that's taking place in the markets as well. And as we can see, the cable had, we had this consolidation initially. Okay, you can see that kind of break. So if I was to just allude to that and draw that out very, very quickly, you can kind of see that short-term break here, okay, of this kind of consolidation. So we had bullish order flow, we had higher highs, higher lows, higher highs, we had consolidation. We did break through this region. However, you can also see that we we were unable to navigate a closure underneath this order flow. And you can kind of see how the price action came all the way back down into this region here. Now, of course, if I just remove that blue area for a second, back to full screen, you can see how the price action held very, very nicely in this region. Okay, the last selling candle before the buying impulse was really in this area here. Of course, flags up, pulls back down, and then since then the markets have recovered again back into this region here, which is now moving stationary or moving sideways into the weekly close between 119 and 119.50. So we're really evaluating the price action around this region to see, is there that tail off or in dollar weakness, is there that shift in dollar strength? Because if we see dollar strength continue to play out, or we get that break of structure through that 107.20 level we talked about in the DXY, we should start to see the cable struggle. We should start to see pressure coming in, and then that really becomes a case of, can we get a price action movement back into this area here between 117.50 and 11800, and then seeing, of course, then can we break structure? Because of course we're getting that flagging structure impulse into flagging price action. We're now looking to see, how is the price action going to react here? Do we try and break for another impulse, or is this really the top formation of price action then to break structure, change sentiment direction bias, and then start to see the bearish order flow coming through? And that's really the big talking point here, is how is the market reacting? Now, 1 hour, very, very consolidated into the weekly close, and you can see on Friday, not really much happened all through Friday. Very, very up and down, 60, 70 point range. Basically, markets trying to be as flat as possible into the weekend to then evaluate then what way the bias is tilting towards. Obviously, for the weekly open tonight, Sunday night into obviously Monday for the new London session. And of course, next week, what do we have in the US? We have Thanksgiving. So you also have to factor in next week, be forward looking into the markets and say, well, we do have Thanksgiving. So we're going to have obviously Thursday closure in the markets. We're going to have a half day Friday. So we're really working off of a much less concentrated week of price action this week, because all of the business will have to be done between kind of Monday, Tuesday, Wednesday, because we know Thursday is going to be off. And then that's really going to simulate a shorter week then into obviously next week, which is obviously the last week of November. Month ends, you then have option expiries. So you're obviously setting yourself up for a shorter week this week, and then obviously a more busier week the week after into month end. All right. So that's kind of where we are in cable. I hope that's useful. Moving across the dollar CAD, of course, dollar CAD is really giving us telltale signs of potential USD strength. So of course, obviously last week you will have probably known that the oil prices particularly in the US, has dropped by 10%, which again has weakened the Canadian dollar. So you know there's a positive correlation between the Canadian dollar and oil prices. Why? Because the oil prices is the primary export within the Canadian economy in the broader sense. So of course, weaker oil, weaker CAD, and then of course you can see that USD CAD assimilate upside direction, because of course the DXY is bottoming out, the dollar starting to pick up a little bit of rotational strength, and you're seeing that CAD weaker in the back end. And of course, we're seeing that area of interest that we talked about over the last week or two, particularly this 132.50, 133 level, seeing how does the price action react. Okay, we broke structure, we come back all the way down. I was looking to see last week, could we break through this level, 132s, and continue assimilating weakness back into this 130 level. Of course, over the week, we've refused to break lower. The dollar's held the bottom, that DXY has held that bottom so far, and we've seen that slight rotational weakness in the oil prices, which has meant USD CAD has moved higher. Now, of course, with that aside, if you look at the order flow, very, very clear structure. One last impulse of liquidity back into this order block area here. Price action gets the break of structure, breaks through, continuation that downside progression, then it's just bearish order flow. So it's then lower lows, lower highs, lower lows into this bottom structure here, as I said, this flat bed at 132.50, and we're making that correctional move here. So from my perspective now, I would be looking to see, can this move continue playing out, and can we get back into this 135 handle? Because as you can see here, we are creating bearish order flow. So a short-term rationality would be to see this continue to play out, get back to this liquidity level up here, and then obviously determining from a market sentiment direction, is that logical? Is that a clear analogy or identifier of what we're seeing within the price action? And of course, being aware of that as well. All right. And then last is then, of course, US dollar yen. So dollar yen has been on an absolute rampage last week, because we had that area of interest around 149, 150. So this was I'm nearly sure this 149 level was a monthly level. I believe it is, if we look at it. is. Okay, so the 149 handle was actually a monthly order block level from March of 1990. Now, I know a lot of people don't look at 1990s or even back as far as that, but when you had such an aggressive move in dollar yen over the last, let's say, 6 months, and obviously we had to look at, right, when was the last time the price action was at these levels? And of course, the monthly time frame, see the price action come all the way back up to 149. It's rejected it directly at this level. And of course, if you go to a weekly chart, you'll see that as well. No weekly closures above the monthly area. We did get a little bit of price action on the shorter time frames up as far as 152, but then we came very, very quickly back down. Was in this range between 146 and 149. And then last week was that initial break back into this area, creating that new structural, I suppose, pullback, new kind of bearish order flow. And you can see very, very clearly how this daily trend so far is still playing out, because we've got higher highs, higher lows, higher highs, back to this liquidity level here. So just back underneath, kind of testing the previous highs, but kind of testing short-term bottoms as well. Gets the elevation break above the 135s, and then churns higher all the way to 150 without any sort of pause or any sort of consolidation. Now, there was obviously a little bit of volatility here. So this is when the Bank of Japan initially said they were getting involved with their monetary policy to try and stop the slide of yen weakness. And then, of course, then we had that deeper, well, I suppose, liquidity, order flow reaction of this 149 level up here. Now, structurally speaking, there's two ways to look at this. Okay, so two ways is obviously seeing the bullish trend. So obviously higher lows, new higher highs, new higher lows. So obviously from a retracement perspective, if we draw it out very, very quickly, we can see how this reaction very, very clearly here was off the 61.8. So normally speaking, it really comes down to how you utilize the fibs. So for me, it's obviously 61.8 is golden ratio, and then looking to see if there's any deeper discounts here. So 786, and then you've got 707. And for those of you who don't know, 707 is the square of 61.8 and 786. So it's the square of both of these two Fibonacci points. So obviously looking at that collectively. So 61.8 was the clear rejection level. We've seen over the last number of days, the yen refused to break underneath this kind of 138.50 level. We did get an initial break of 138, but very, very quickly came back up. And of course, then you're really saying, well, price action is showing bullish order flow. So you've got a higher time frame, higher high, higher low, higher high, higher low. The likelihood is, of course, if we see the GXY break through this 107.20 level, we should be looking at dollar yen migrating back up into this zone. Okay. And of course, if you look at the daily time frame, you will see very, very sharp sell-off into consolidation. Very, very sharp run-up would be a potential identifier back into this region here. And of course, that then is putting the bullish scenario of higher highs, higher lows, higher highs back up into this region for a potential run-up to the upside. So that would then be saying, well, if that trend is going to continue, could we then say, well, this is the new higher low? Could we then try and push it back in? Well, whether we get to new higher highs is obviously the big question. But from a short-term perspective, you would definitely get kind of a 400 to 500 point potential pullback into this level up here. And I suppose that will be kind of, from a short-term perspective, bigger clue to watch out for. Now, when you look at the 4-hour charts, if we look at from the other side, let's just say, for example, that this proved to be a market top in the dollar. So you can see here off the monthly level, very, very sharp impulse, grinds up, breaks back down, consolidates, consolidates, consolidates. So you've got that structured level here with the gold broken line, price action breaks down. So really there you're looking for saying, well, yes, we have the bullish trend on the higher time frame analysis, but you're also seeing here as well, you've also got this kind of moderated potential 1 hour, 4 hour pullback. It's all about looking at risk reward. It's all about looking at the longer term trend with the shorter term trend and seeing, can we get that obviously break of structure? Can we get that relief rally? And then can we start to see that gradual grind higher back up into these levels? So maybe something like that would be particularly interesting. But again, 145, 146 would be the opportune area of interest for recovery once the price action starts assimilating your viewpoint. And I think it's just about being patient here, because of course you do have the last buying candle before the selling breakout, which comes in here at 146.12. So really that's going to be the point of interest that I'll be looking at to see, can the price action start to get the flagging structure back into this area of interest to see, can we mitigate it? Now, that will be a case of, well, if this is the cycle high and this is new lows, because of course this short-term low here was broken. Okay, you can see that there very, very clearly, this low here was broken. It then becomes a case of, well, obviously higher short-term higher lows, new higher highs, new break of low structure. And then you're really looking to say, well, from a bearish perspective, the bears coming into town, are we going to get that change in sentiment? But either scenario, you would definitely be looking for a pullback, whether the longer term trend is bullish or bearish. Short term trend, you should still see a corrective move back into 146 first, evaluate the price action, see how is that reacting or how is that developing, and then maybe if you're a longer term bullish trend doesn't really happen, well then you're liquidating your buys, or then if you're seeing the change in sentiment, you're seeing that longer term dollar weakness come through, cyclical reversion in dollar yen, then you're really getting out of your longs here and you're maybe looking at loading up in shorts. That's just a scenario analysis based on which way the markets are potentially leaning towards. But either way, you'd probably get a very, very nice pullback to the upside if it's a case that the dollar sees some strength. And of course, using correlations with the markets to help you with that as well. All right. Now, moving across for the weekend markets, we're seeing that very, very clear gold sell-off. So structurally speaking, gold has been obviously on a rampage the last couple of weeks as well. It's churned higher, so you can obviously see that break of the 1720s we talked about over the last couple of weeks. And of course, we said, well, if we break 1720s, we're really looking at this area up here between 1790 to kind of 1800. So we've got a daily level here at 1790. We've got a 4-hour level in between, just underneath 1800, and then we have got the previous break, last bullish candle before this breakout occurred at 1807. So those are kind of the three anchor points that had an interest. Now, of course, if you look at the price action last week, what happened? We had that bullish order flow, grind higher, steady grind higher. We start to wick reject. You're kind of seeing, well, is there going to be a reaction at the daily 4 levels? And unfortunately, there hasn't. So from my perspective, I was really looking for a reaction from either of these two levels myself from a liquidity standpoint. And of course, that hasn't really played out because the market has very clearly reacted. Of course, we have made that short-term bottom here at 117.55. And now we have kind of broken through. So you can kind of see here, price actions migrating to the downside. So now we're starting to create bearish order flow. So now it becomes a case of, well, if we are going to get back into this daily 4-hour level, we're really trying to break this new bearish trend here, which then really looks at some of these liquidity areas here at 1770. So if we're getting a closure back above 1770, like so, then you're probably looking at this being a pullback and then looking to see can the price action take on. But also, the other scenario is here as well, because we haven't mitigated this level and we're creating bearish order flow, it then becomes a case of determining where does the bearish order flow end, right? Because we've had this level at 1720, we broke straight through, we didn't even get any sort of reaction from it. We could kind of do a short-term filtration of selling back into this level to then maybe allow one large impulse back in. So that's another scenario to potentially have on your radar. So at least that way then when you are looking, you have got a clear synergy of what you're looking at, marking up your levels, understanding the price action, and being able to make clearly defined decisions off the back of that. All right. From a 1 hour perspective, again, very kind of messy, very convoluted price action, just kind of clearing the charts up. So like even here again, we've got obviously break. So we've obviously got consolidation here. So would it be impossible to see gold rally back into 1764? I suppose that would be the interesting level. So I definitely be leaning towards kind of a more intermittent, medium-term bearish trend, given that gold is now broken down. But I suppose structurally speaking, it's a case of can we get a flag back up and then maybe see that type of move? That would be interesting because you're starting to see now short-term bearish order flow, lower highs, new lower lows again. So we're starting to see the creation of the bearish trends. It's just about being aware of that as well with the price action. All right. Then moving across the gold, we'll finish off then with the indices. Obviously, oil, as I said, continued to sell off very, very aggressively. So this daily order block held absolutely beautifully here on oil. Strong impulse, trailer tracks, bearish engulfing back underneath 93, sold off, got the initial impulse. We've got mitigation on the daily, firstly, then we got a retap. Price action tried to break through again. Second mitigation, double mitigation, rejected very, very clearly. And has since then just completely unwound back to this level down here at 80. So that's going to be really positive for those of you in logistics, or for anyone who's maybe in logistics or in transport or traveling to and from work with quite long distances. Obviously, the weaker oil prices is going to help with the petrol, with the diesel, with the fuel. So that is obviously going to be a key element of interest, obviously, into year end, because of course, seeing obviously how does that pick out as well. And of course, the stronger dollar, weaker supply side, weaker demand curves would then mean that it wouldn't be conceivable to see obviously the oil prices continue to drop. And of course, 76 is where the current US oil lows are on WTI. And of course, obviously, if that breaks down, really then you're looking at this massive bullish impulse from the early parts of 2022. So from 70, then becoming the mitigating level. Okay, so then you've got mitigating levels here at 64, which was mitigated way back in November. Then you've also got a secondary level at 70. And then that creates this continuation of bearish order flow where we've sold off bearish order flow into consolidation, and the price action is looking to take this week. So that's really kind of allowing this shift in demand to weakness. Of course, less of a demand means weaker oil prices, which brings everything back down to more accommodative levels. However, we've seen weaker demand from an economy perspective generally means recession. So it's just about being aware of that dynamic as well. So last but not least, as I said, moving across the indices. Indices have been incredibly choppy over the last week. So from the S&P perspective, daily order block here at 4065 we talked about last week still hasn't been mitigated. We've got a 4-hour level at 4100 or just slightly above 4100. Excuse me. So we're really kind of looking at these areas of interest to see, because of course, new lows, cyclical retrace. Obviously, the CPI manipulation took the highs, took the lows. Should I say? Obviously, new short-term highs, bullish trend corrective. Okay, so we've made new higher highs again. So we're seeing, is there a short-term pullback? It does look like you could get, from a daily perspective, what you would like to see happen is pullback, new higher high, get back in to mitigate some of these levels, and then maybe see the shift in sentiment in that way. But of course, I suppose your daily previous high here at 3900 was rejected fairly cleanly on Thursday, which is obviously given cause for say, well, we've come back down to this level, although we haven't mitigated this order block here, or the impulse from the CPI move, which was from 3760. The markets obviously did form a short-term top. So it really just becomes a case of this week, can we navigate below 3900? Because if we can, that would then instigate, right, short-term recovery, sell off back into this order block, clean out this buy-side imbalance that we saw from the CPI, make a new higher low, and then of course, can we get then that final impulse, finish the year strongly in the stock markets, get back to 4100. And that's really kind of that's going to be the big talking point probably now over the next weeks, because of course you will get volatility into Christmas week, but a lot of the business from the institutional perspective will be done by the end of the Fed meeting, by the end of the ECB meeting, by the end of the Bank of England meeting. And those meetings generally happen around the 16th, 17th of December, sometimes maybe a little bit earlier depending on how the calendar forms. So then what happens then the last week of the year is effectively manipulation, because we saw that last year. If you go out to the stock markets way back last year, what we actually saw was very, very strong movements from the from the 20th, really from the 20th onwards. We got markets rallying all the way into year end. Of course, the 28th, 30th, markets finished high. And of course, then what happened? We got that hunt of the highs. So basically into year end, we got the markets making new all-time highs, only for the highs to form at the 4th of January, or the 3rd, 4th of January when the markets reopened. And that was really the high of the year, because since then we broke back underneath. We created bearish order flow. We broke through this range, bearish order flow. And then since then, everything else is history. So you just have to be aware of the manipulation into year end as well. So obviously looking at that from a perspective as well on the stock markets, being able to tie that back in. And of course, Nasdaq is very, very similar to that, because of course, we have broken above the October highs, and of course the month-end October highs, which here was around about 11,650, 11,700. We did get an impulse last week into 12,000. We have come back down. We have made new short-term lows, pullbacks. So again, similar to this, when you look at the 4-hour structure, we had made this idea of, right, can we now continue moving higher? Well, we got an impulse to 12,000. That's eroded. So now we've actually broken the structure, short-term speaking. Price action now is reacting off of this. So what I would say is be careful to see if there's any sort of maybe hunt of liquidity in the early part of this week. If the price action is not breaking through, let's say 11,900, 12,000, then you're probably looking at price action unwinding. And then you're really looking at, well, that new higher low scenario of the order blocks from the CPI figure, this imbalance, cleaning that up, cleaning that liquidity, and then seeing can we progress then beyond that after that liquidity has been cleared out. And that's really the big talking point. Similarly, again with Dow Jones. Dow Jones has rejected the daily level here. So this daily level here at just underneath 33,900. It is 33,887. Very, very clear rejection on the daily. So of course, if you're still bullish on the stock market, you're still bullish on Dow Jones, we basically need to see this week can the markets make new highs. So that's above 4,050 on the S&Ps, above 12,000 on NAS. And of course, taking out this daily level here at 3387, if we're getting a daily closure above this, you're thinking then, right, can the price action take the liquidity highs, which is just over 34,300, and then go for this daily order block up here, which is set at almost 35,000. And of course, that then becomes the talking point. So really this week, it's just determined on how does the price action react, because we have seen the price action hang around. We have seen a strong closure into the week, but you don't want to see a short-term closure or strength Friday and then see that just as manipulation. Impulse on Monday, midweek reversal on Tuesday, sell off into Thanksgiving, because that really does put the pressure on. So that's going to be the interesting element here to watch, given that the price action last week had initially broken structure to the downside. And you can kind of see that there as well. So we've consolidated, we've broken structure to the downside. We've now flagged back up into this region here between 33,800 and 33,900. So as I said, if we're not breaking through this, it does put the pressure on that this was maybe the impulse. This is the mitigation, and then seeing that maybe unwind back down. And that's just really something to be aware of, because if the dollar picks up strength, you're going to see the end of this corrective move. You're going to see the unwind. And of course, out of stock markets into dollar. And that's obviously the reaction there. FTSE as well has been hanging around at this daily level. So this has obviously been quite interesting. So FTSE, bearish order flow, very, very clear. So you can kind of see it there on the charts. Peak highs, of course, way up in this level. But if you look at the price action over the last number of months, bearish order flow, new lows, new pullbacks, short-term impulse back into order block mitigation level, of course, which has been mitigated, as we said. New lows again, 6,800, false breakthrough 6,800, which the price action is obviously held above. And then, of course, we've got that gallant rally back into this daily level here at 7,400. And of course, if you noticed on Monday, Tuesday, Wednesday, last week, very, very strong reaction, tried to break out through it, it's failed. And of course, this week, you can see on Friday, we just about navigated closure above this line. But of course, we could very easily see, well, can the price action react up to this level? Because if you go to a 4-hour chart and you isolate the price action, you can also see that there is a 4-hour level of interest up here around 74.62. So of course, you could see the price action grind higher, take out the 4-hour order block liquidity, and then have the start turnaround where this is the final piece of mitigation into the daily area, manipulation of the short-term tops, and then seeing that reversal. So I suppose that's really something to be kind of aware of, be careful of this week to see how does the markets react. And then that brings us to finally then towards the DAX and the Euro Stoxx, which again is continuing to move higher. So the DAX has this daily order block level up here around about 14,500 to 569. I did mention it last week. I was kind of watching the DAX and Euro Stoxx closely. DAX is getting there, so I suppose worth waiting to see if there is a sort of a reaction off of that daily level after the consolidation of the choppy volatility this week. So this could be short-term impulse, take the liquidity, and then unwind. Just be wary of that. So this obviously, for those of you, I can guarantee there's probably a lot of people getting short on the DAX last week because they probably saw flagging price action, breaking structure, coming back into this region, which was something we did identify, but just being aware that there was a daily level higher up here as well, just to be kind of conscious of. So just keeping all options on the table, looking at all scenarios, just being aware where is the invalidators, that if you are short, let's say, where are you getting out? Or if you are looking for a re-entry, where does that take place as well? All right. And then, of course, then on the Euro Stoxx, very, very clear reaction back off of this level. So the daily, so there's a 4-hour level here, which we have currently rejecting. So you can see multiple 4-hour rejections at 39.25 on the daily, of course. So there's a daily and a 4-hour level. So if you go to a 4-hour chart as well, you'll see that there is a 4-hour area of interest here as well. So the 4-hour level is actually up here. So there's a slight deviation between the daily and the 4-hour charts, but you can see that they're really in the Euro Stoxx, they're within about 10 points from each other. So that daily 4-hour zone, as I said, between 39.20, 39.30, and you can actually see that we've rejected the 4-hour zone on Friday to a T. We have come back up and we are holding underneath. So I suppose now we're looking for that break of structure to see if there's any sort of break to the downside. So of course, now that we've mitigated, can we break structure? Can we flag back up? Can we start creating bearish order flow, let's say, for maybe 1 or 2 weeks? And that's really going to be the talking point from here. All right. So a really good, interesting video here for the weekend markets. So of course, we will be back throughout the week because of course the bank holidays, factoring in on the price action. So we are expecting a couple of busy days, Monday, Tuesday, Wednesday. And of course, gearing up for, as I said, what is going to be a shorter week, particularly for the US markets as well. Have a great weekend, everyone. Trade safe.